There is a candle on your chart right now that the bank already traded through. You just don't know which one. Most retail traders stare at price and see noise. Institutions look at the exact same chart and see a paper trail. That difference is the entire game. Here's what nobody tells you about order blocks. They aren't magic zones. They aren't drawn from intuition. They're leftover evidence. A footprint in the sand after someone heavy walked through. Why does that footprint matter more than any indicator you've ever used? Because size creates a problem. A retail trader can buy 10,000 units and the market doesn't blink. An institution trying to buy 10 million units cannot just click a button. The order is too big for the liquidity available at any single price. So it gets broken apart, filled in pieces, absorbed quietly, candle by candle, while price appears calm on the surface. Richard Wyckoff figured this out almost a century ago, long before order blocks had a name. He called the driving force behind these moves the composite operator, a theoretical single mind behind accumulation and distribution. Wyckoff watched volume and price together and noticed something traders still miss today. Before a real move happens, there's a quiet phase. Price barely moves. Volume tells a different story than the candles do. That quiet phase is absorption. And absorption leaves a mark. That mark is the order block. The last candle, or cluster of candles, before price makes an aggressive directional move is usually where the bulk of that institutional order got filled. Not the whole order. Just enough to tip the balance. Once the balance tips, the market runs, because now there are far more buyers left waiting than sellers available, or the reverse. Price doesn't move because of news. It moves because supply and demand at that price level just got wiped out. So why does price often return to that exact candle later? This is the part that confuses most traders, because it feels almost too convenient. The answer is simpler than it looks. Institutions rarely fill an entire position in one shot. They leave resting orders behind. Unfilled portions. Stop losses from the initial entries. Hedging positions that need adjusting. When price revisits that zone, it isn't magic. It's the market going back to collect unfinished business. Michael Huddleston, known across the trading world as ICT, built an entire framework around this behavior. He didn't invent order blocks from nothing. He formalized what floor traders and institutional desks had understood for decades, then made it teachable. His core idea is direct. Smart money leaves footprints, and those footprints are readable if you know the anatomy of a move instead of just the direction of a candle. Let's break down that anatomy, because vague zones on a chart are useless without precision. A valid order block sits at the origin of a strong displacement. Not any displacement. A move that breaks structure. A move that closes beyond a previous high or low with conviction, often leaving what's called a fair value gap, a visible imbalance where price moves so fast it skipped over normal two-sided trading. That imbalance is important. It tells you the move wasn't organic buying and selling. It was one side completely overwhelming the other. Now here's a question worth sitting with. If everyone can see the same candle, why doesn't the zone stop working once it's public knowledge? Steve Nyssen, the man credited with bringing Japanese candlestick charting to the Western world, made a similar point about patterns in general decades ago. A pattern isn't valuable because it's secret. It's valuable because it reflects real, repeatable human and institutional behavior under specific conditions. Order blocks work for the same reason. The mechanics of large order execution don't change just because more people understand the theory. Big money still has to enter somewhere. It still leaves the same kind of evidence behind. But precision matters more than most traders want to admit. An order block without context is just a rectangle. You need confluence. Where is this zone relative to the higher time frame trend? Does it align with a previous area of liquidity, like equal highs or equal lows where retail stop losses are likely sitting? Is there a fair value gap inside the zone confirming genuine imbalance? Does the move originate from a clear break of structure, not just a random swing? When those elements stack together, you're no longer guessing. You're reading a story the market already told you. Price swept liquidity below a recent low. Then it displaced aggressively upward, leaving an unfilled gap. Then it broke a previous high, confirming a shift in structure. The candle where that whole sequence began is your order block. That's not decoration. That's the origin point of institutional intent. Why does this fail sometimes? Because it does fail, and you need to know exactly when. The first reason is context. An order block against the higher timeframe trend is fighting the dominant flow of orders, and even if it reacts briefly, it's far less reliable than one aligned with the broader direction. The second reason is over-mitigation.
Zona rente infinite.
Every time price returns to an order block and pushes through it rather than reversing, that block has likely already been mitigated, its unfilled orders absorbed. Trading a used, exhausted zone as if it's fresh is one of the most common mistakes retail traders make. The third reason is news and volatility events. High-impact data releases can override normal order flow entirely, because sudden repricing based on new information doesn't care about your technical zone. And the fourth, often ignored reason, is timeframe mismatch. An order block on a 1-minute chart is not the same weight as one on the 4-hour chart. Size of the footprint matters. A bank doesn't leave the same mark on a 1-minute candle that it leaves on a daily one. This is where risk management stops being a boring add-on and becomes the actual skill. Even a textbook order block, sitting inside perfect confluence, aligned with trend, backed by a fair value gap, is still a probability, not a certainty. That means your stop loss goes beyond the zone, not inside it, giving the setup room to prove itself without exposing your account to an unreasonable loss if the read is wrong. Position size gets calculated from that stop distance, not the other way around. Professional traders don't decide how much they want to make and then reverse engineer a stop loss to fit. They decide how much they're willing to lose, and let that number shape everything else. Think about what changes once you actually understand this. You stop drawing random boxes on your chart hoping they hold. You start asking why a zone should hold, based on displacement, structure, and unfilled liquidity, instead of just because a candle looks big. You stop chasing price after it's already moved, and start waiting for it to return to the origin of the move, where risk is smallest and the logic is clearest. None of this guarantees a winning trade. No framework does, no matter how it's marketed to you. What it gives you instead is a reason. A reason price behaved the way it did. A reason to enter, and just as importantly, a reason to know when the setup has failed and get out without hesitation. That clarity, more than any indicator, is what separates traders who last from traders who blow up chasing certainty that was never available in the first place. So go back to that candle you keep glossing over on your chart. The one before the big move. It's not random. It's not decoration. It's a footprint the market left behind. And now, finally, you know exactly how to read it.